Hi, I'm George Nordhaus, and welcome to Monday Morning. Premium financing has always been important in our business, at least as long as I can remember, and it's a tremendous tool that people use. I've been working with premium finance firms, I don't know, for many, many years, back when AFCO first started and so forth, and many more in the succeeding years. But a lot of new ways to use it are coming along, and when I heard about Stewart Sheppard, who is the Premium Finance Brokerage, the owner of that, incidentally, which is quite an unusual deal, I contacted him, and here we go. So let me tell you about Stewart. Stewart, welcome, my friend. Let's see your beautiful picture here, huh?
Oh, boy. Hold on one second.
There you
we
are.
Go.
Attaboy. All right.
You think that's beautiful, huh, George?
Well, I didn't.
That's a lot of photoshopping in there.
All right. Tell us a little bit about your background, will you? Or tell us first, who is Premium Finance Brokerage? Because you're relatively new.
We are, George. I've been in the premium finance business for 18 years, and I started PFB in 2005. And although we're unique to the premium finance business, the principles by which we're founded are very much like clustering in the insurance agency spectrum. So what we are essentially is a group of premium finance professionals, of which there's 10 of us now in marketing. And what we have done is we have banded together just like a group of agencies would.
Wow. For
the benefit of purchasing power, for profit sharing, and for those types of things. So it's unique in the sense it's new to premium financing, although we're built on the same principles that many of, I'm sure, your members or just agencies in the field, what they're doing today. But essentially, we've all come together. We originate business, and we place that business with several national providers that we represent. We have the ability to finance any size transaction. And as of today, we're the largest privately held aggregator in the country, and we have financed over $1 billion in loans.
Boy, you're to be congratulated. That's a tough way to start the way you guys did it. I like the concept. I see your background there too, and you were with Travelers, and you had a lot of insurance company stuff, so you knew both sides of the coin, huh?
Well, I started my career with the Travelers, and I spent the first 10 years of my career in working in both underwriting and marketing for those carriers, and I got into the premium finance business. And I worked for a company that was owned by a big national insurance carrier, TIG, Transamerica Insurance Group. And when they were sold to a competitor, I went to work for a startup operation, which is really what got me my start in PFB. And when they sold to a Texas bank back in 2005, it's at that point I decided, you know what, I've worked long enough for somebody else. It was time for us to do it on our own.
Yeah, been
so
there,
we hung a shingle out in July of 2005, and
off we go. Well, I hear you, and I'm proud of you. Let's go. Let's take a look at the challenges. What are the challenges of premium financing?
Well, what I thought I would do here, George, is kind of get away from maybe some of the norms of what an agent today, in working on that smaller account where it's typically quoted through technology, where the system will give you an interest rate, it will give you terms, down payment, number of installments. I thought what I would do was really focus in on what I see is a big challenge with what's happened with the insurance business, and more specifically, what's happening with premiums. So the first thing I want to point out, and we're going to use a hypothetical account, okay, and I'll refer to this from time to time during the course of the presentation, but let's take a $100,000 risk. What we're seeing, and I deal with this almost every day now, George, is there's a tremendous financial stress that's being applied to the client because we're seeing premium increases. They can range anywhere from 15%. I've seen accounts more than double. Unfortunately, when you look at what's happened with the economy, we don't see the other side of the ledger keeping up with that increase. So when you look at the sales, when you look at how the company is doing, the company may be stagnant, but this stress on the client from increased premium is becoming a real problem. So what we look at is, what's the cash flow? What's the ability of this client to make payments now when you have a 25, a 35, 100% increase? Do they have the ability to pay and afford that increase? Debt load is different today than it was 10 years ago. And the reason for that, George, is we see now assets that's worth a lot less than what's owed. So when you look at the client's ledger for liabilities, do they have an ability to shed this debt, to raise funds to pay premiums? And can you shed it and pay off the asset and at the same time have money left over? And that's a real problem today. And I'm sure you've seen it where you live. It certainly has happened up here where there's been such a devaluation, especially with property. So if you're leveraged, it can put you in a real bad place if all of a sudden now you have to make payments and you can't get rid of assets and cover the cost of what's owed on that asset. Okay. So this has become, I'm not going to say it's a crisis, George, but we get questions all the time about modifying payment terms. And these are some of the challenges, and we'll talk about more of this. But this usually results in an agency calling me and saying, look, I need to drive this insurance payment down, or I need to drive this insurance deposit down. So if normally we're asking for a down payment of 20 or 25%, agent may come to me and say, I need to get 10% down, or I need to get 8% down, or equal installments. Mm-hmm. So continuing on with these challenges, what happens now is when we get this risk, we underwrite what's the exposure the finance company is willing to take. Excuse me. How much risk is the finance company willing to accept for this client? Because as you change those payment parameters, George, the finance company is taking on more risk. The other component is the company threshold, and this is more on the insurance company side. Who is the carrier you're bringing to us who's insuring this risk? I'll give you a great example, and this just happened here. We had a carrier domiciled in Maryland, which is where I live, who was rated by one of the rating services as being an A-rated carrier. Unfortunately, from the point that they were A to the point that they went into receivership was about 18 months. Mm. So finance companies now look at what's the capacity, what's the threshold that we're going to take with a carrier. Is this carrier at risk? Is this carrier going to be downgraded? And so often, George, and I'm sure you hear it from agents, the speed with which a carrier collapses, especially smaller companies and risk retention groups, it seems like as soon as there's smoke there, or as soon as they're lowered to a B+ and unable now to get an umbrella over top of them, it's like people now run from that market. This part in our world doesn't happen every day, but it's something that is part of an overall package when you're trying to structure a deal. This can come into play. But so often today, we're seeing these changes so rapidly where a carrier one day seems to be okay. 18 months from now, they're having trouble. I mean, real trouble. Excuse me, where they're being, like I said, put into receivership. The other thing is the line of coverage. And we look at in this market, can you take a property policy, put that policy on a pro rata wheel, and determine what that return premium is going to be in the event it cancels? And the answer to that is yes. We can determine with certainty what that return is going to be if the product or the policy is not auditable. If it's auditable, you can't do that, George. What happens is, if you're waiting for an audit to determine what a return is going to be, you can, in a general sense, get a feel for where that return is going to come in. But if all of a sudden the insured is having a great year and that payroll really spikes, well, that increase in payroll is going to increase the premium. If we cancel that coverage, the return premium becomes less. So that could result in a shortage on the return premium so that we're not covered on the loan balance in the event of cancellation. So the lines of coverage come into play, especially on larger risks. So the last thing, again, we're looking at a package. The last thing that's looked at is the credit. Now, the services that are typically used by finance companies include Dun & Bradstreet, Experian, and audited and unaudited financial statements. Dun & Bradstreet, in terms of the credit services, is by far the most looked at in our marketplace. And there's one piece in particular that they hone in on. It's called a Paydex rating. It's almost like a credit score. Paydex, George, is how you pay your bills. Are you paying your bills on time? If you're paying your bills on time, your Paydex rating is higher. If you're not paying your bills on time, your Paydex rating is low. A lot of times with D&B, companies don't subscribe to it, so you can't find financial statements. It's hard to get a lot of detailed information with regard to our world in terms of putting a package together. But that Paydex is something they really look at. The other thing is the financial statements, especially the audited financial statements. And that really tells the picture about how this insured is doing financially. Mm-hmm. When you look at the history of the client, the payment, how they pay their bills, if this is a renewal for the agency, if we as a provider of financing can go back and look at how much this insured paid and how they paid, it gives us it gives us an indication. Of course, it doesn't predict the future, but it tells us, hey, this person paid on time. They paid all their installments. They never went to cancellation. And I can tell you in our business, George, that if you're late a few times, that's a good thing for the finance company, because the fees associated with that late payment are tremendous. It's 5% of whatever the installment amount is. So that's a significant penalty. So a finance company, I can tell you from experience, they want you to be late, just don't cancel.
Yeah.
The cancels where the cost comes in. Being late, that's nothing but an automated late notice and a fee attached to that. So it's okay to be late, but just don't cancel.
Okay, well, you have a policy for cancellation, Jeff?
Absolutely. Now, the cancellation provisions on this, again, going back to our example, if you have a minimum earned, which most accounts have in our business that we finance, typically, George, is 25%. But what that 25% does, again, let's go back to our example. We have a large account, we're trying to get terms on it. So if you have a 25% minimum earned and you're asking me for 15% down, the moment we write that deal, we take on a $10,000 principal risk. So if they make no payments, we're behind the curve. And I'm going to show you later how you're essentially behind the curve throughout the life of the loan. But the most significant piece is that first payment. If you never make a payment, you're taking a $10,000 principal loss on that account. So here's the exposure analysis on the deal. Again, this hypothetical account. We have a $100,000 risk. If you look up at the top of that screen to the left, where it says parameters, and below that it says premium. Here's a $100,000 risk where we have a 15% down payment, or $15,000, which is down towards the middle of the screen. And down below that, you'll see number of installments at 10. So we have 15% down, 10 payments on a $100,000 premium with a 25% minimum earned. The collateral on that deal is to the right, George, where you see collateral analysis. Over the life of this loan, at no point is the company fully secured or collateralized. So this paints a picture for an agency. Again, you come to us with a problem. My insured has suffered a significant increase. The financial stability of that client, we're trying to do due diligence on. But usually, when it comes to us with looking to lower a deposit, extend the life of the loan, drive down the APR. It's usually one of those three things, George. But I think what this does so far is it gives you a perspective of what we go through as finance people. When you ask for these accommodations, when you ask for these special requests, it's the understanding of what we go through. Now, the benefit of working with us is that we represent several markets, just like, again, using the agent example of representing all these insurance companies. We have the ability to take this risk to several finance companies and have them look at it. And just like with insurance companies, finance companies will view risk differently. Some are willing to accept more. Some don't want to accept any. But what we can do is we can package this and say, we've gone to 6 markets. So when you talk to your client as an agent, you've gone to the market. You've turned over every stone. And you can tell your insured, look, I've gone to 6 finance companies, and this is the best we can provide.
That's interesting. Let me ask a question. I see you have a contract rate is over there like 6%. Is that normal, or is what is the interest situation these days?
Well, for that size account, that's a competitive rate. I priced it. I put that there, George. Can we do better? Yes. I put that rate there because a lot of times agencies look to make revenue from financing.
Yeah,
so when you look to make revenue, it affects the APR.
Okay.
So the more that they increase the APR, the more income to the agency.
Well, let's let's talk then about the opportunities that you have that premium financing brings up.
Sure. Again, I wanted to focus more on what are the things outside of the norm, outside of that deal you quote, using technology, where it's a $5,000 E&O policy or D&O policy that you process on your own. Things that we can do, and this first one here where I talk about audit premium or prior balances, this actually happened to me yesterday. I got a call from an agency of mine in New Jersey, and the guy says to me, I've got a fidelity bond. Can you finance that? Now, fidelity bonds, George, typically are fully earned. If you call customer service at the finance company, chances are they're going to say, well, we can't finance that. That's a fully earned policy. Fully earned being, hey, look, if I cancel it, I get no money back. And in the premium finance business, your collateral is based on the unearned premium. So if I can't get any money back, it becomes a challenge. So the patented answer is, I can't help you. Our answer is, let's look at this. Let's look at the bigger picture. Now, with this particular risk, I asked the agent, I said, well, do you have anything else we could put with this? Do you have any, like a package or a BOP or a GL policy that I can wrap around this fully earned policy and make it more palatable to the finance company? So if I can get my hooks in something else, and we can say to a client, look, if you don't pay us, we're going to cancel your other coverages. It makes it a lot easier to do that deal. If it's a standalone audit or a standalone fidelity bond, it becomes a real challenge.
Got it.
Now, fortunately for this agent, we were able to do that. We took a $15,000 BOP and commercial auto. We wrapped that around a $3,000 fidelity bond. So we financed the full 18. And we were able to give that client competitive terms.
I got it.
So the patented answer is, these are lines that typically aren't desirable to finance companies. But if you have them, think in the context of, what can I put with it?
Good idea.
Now, I talked about collateral. Another element of collateral is the agent's involvement. So let's say we have the same scenario, and I go to the agent and say, look, I can't get this done on its own. If you're willing to step in and provide a portion of a guarantee so that the finance company gets their money back. And agents will do that, George. Not every one of them, but some will. Some will say, look, this is a great client of mine. I've had this person for 40 years. It's a generational account. They've been a perfect pay. A case might be, hey, look, I loan them some money to pay for an endorsement, or I help them with a deposit, and I want to get that money back. Well, let's take that balance. We'll put that into the deal. You provide a guarantee. We'll give it back if it cancels. I mean, those are things, by the agent willing to step in, it means a lot to the finance company.
Yeah, you see why it would. I never really thought of it. I never thought that. Well, go ahead. I want to. What I know is not a lot about this, but I didn't realize that agents were actually guaranteeing it for some.
Well, it's not something I can tell you as a, and I consider myself more of a risk manager, more of a confidant to an agent because we work for them. These types of deals, this is the last thing you want to get involved with.
Yeah.
So you really want to extinguish every other option you have to get a deal done without having your client participate in the risk.
Got it.
Because I've had some of these deals go bad, George, and I think everybody goes in with the best of intentions.
Right.
You never think it's going to cancel, but sometimes they do.
Yeah.
And the last thing I want to do is go to an agent and say, you got to cut me a check for 10 grand. So we tried to get away from it, but it is an avenue that if the agent has that much faith in the risk, and we all say together, look, we're all taking a piece. So you're going to lose some, we're going to lose some, the finance company loses some, we're all participating in it.
All right, let's go to the last of the opportunities now.
These are things, George, that are really becoming, as a market tightens, risk retention groups tend to be used more.
Yeah.
And if you're an agency who's using a smaller finance company, these are types of businesses or types of markets that a lot of people stay away from because they're higher risk. And I'm sure you've seen it, George, where you roll, a risk retention group gets put out there, and for the first 3 or 4 years as they're building this thing up, everything's great. And then losses start to develop, and all of a sudden you start to hemorrhage, and these things go out as quickly as they came in. So there's a much higher risk with these types of things. But these are businesses, or these are our companies, these are insurers that we can help you get financing for. But there is a risk there, and there are many agents that stay away from them because I think your E&O could be at jeopardy if they were to go under. But we can get those done. Captives, another higher risk type of opportunity that you may not be able to get financing for. We can potentially help you there. And then programs. If you're an agency that has a book of lawyers' professional liability, or you have some specialty line that you're writing for a group, we are able to customize something for you. So if you as an agent are an expert in X and you want to increase your value and financing is a part of that, we can customize a program specifically for that line of business or that group of businesses.
All right.
And maybe it's lowering the deposit. Maybe it's offering equal installments, or it's a flat APR. But those are things that, as opposed to going in and quoting it and letting the system give you a contract that shows 25% down in 9 payments, let us come in and look at driving that deposit down, maybe to 10%, and offering 1 or 2 extra installments. So greater flexibility for the client, also giving the agency a competitive edge. I also wanted to show on here the impact of financing on smaller accounts or personal lines like homeowners, dwelling fire policies. This is something we see a lot in a tightening market, George, where typically a standard carrier, an admitted carrier, is going to offer a direct bill option. What tends to happen in a hardening market is the direct bill options tighten up some for the carriers, where before they would be offering, let's say, 12 monthly installments or offering 10 monthly installments. Well, now maybe on smaller risks, they're saying, look, we'll give you a semi-annual pay. Well, for a $2,000 risk, that could be $1,000 down. When you look at a smaller account, take a look up top where it says amount financed and shows $1,500. If you take that account with an APR of 9.99, the 6th line down is total interest. This is the interest on the loan at $63. So here you have an account. If you take that 63 divided by 9, George, it's $7 a payment. That's the cost of direct bill. So we can effectively give this insured a payment plan a little more flexible, potentially, than what they would get with the carrier for the cost of direct bill.
Something else new I learned. I didn't have any idea that that was happening. Well, let's wrap up here with, because before we do, let's. I've seen your finance project going, and Premium Finance. Can we explain that just a little bit here before we end?
The physical. The
Premium Finance physical. Yeah, the physical. I'm sorry. Yeah.
This is something that we do with really every agency relationship. And you can find it on our website at premiumfinancebrokerage.com under the About Us tab. We do an analysis, and I can offer this to any participating agent that you do business with, George. If all you want to do is find out, what is my current deal? What do I have? Is this program competitive? Am I getting the right value for my clients? We are more than happy to come in and do a premium finance physical, which is an analysis of your portfolio, where we're going to drill down on exactly what you have. how much volume you have, what's your average size account, what are your current APRs, what are your current payment terms, and we can look at each premium band that you have, 5 to 10,000, 10 to 20,000, and we can tell you, look, you've got a good deal, or this is where we think you need help. But we view ourselves in this business as although not experts, everybody here has at least 15 years of premium finance experience, George. So we like to consider ourselves more, as I used the term before in the industry, risk managers. We manage this asset for you. And if we can help you either give a better value to the client, increase your revenue stream as an agency, that's a win for everybody.
Well, it sure is.
We're happy to do that. And we do that for our own clients or any prospective client that we're meeting.
I know. I work with one of your guys now, and Ted Mast is a tremendous guy, and I can't resist saying his name. But anyway, he used to be with the Indiana Big Eye, as I did many years ago, as a matter of fact. At any rate, Stewart, how do we get hold of you? How can people get hold of you?
Well,
there you go.
You can feel free to send me an email. My email address is there.
Yeah, okay.
The best way to get a hold of me, George, which I'm sure is the best way to get a hold of you, is to call your cell phone. I spend most of my life on the road, calling on agencies and calling on carriers, and I spend a lot of time.
Yeah, I
although I'm
understand
the owner, I'm on the field or in the field and on the road all the time.
I know it. That's the name of the game. Well, listen, thank you very much for presenting this, and I learned a lot about premium financing today I had no idea about, and I hope our members have too. I mean, I suggest that our members you can always go back to the email that came in and go to the archives there, rough notes, Agencies Online, whatever, and go to the quiz flash, the daily quiz flash, and the errors and omissions tip of the week. So once again, Stewart, thank you, my friend, and we'll be working together, I know, a lot in the years to come.
George, thanks so much for having me. I really appreciate the opportunity to speak with you and speak with your members.
See the rest of you next Monday morning.